All right. Well, welcome everybody. We've had a bit of a spell the last few weeks, and we just thought it was timely with the federal budget on Tuesday night, just to give a bit of an update of our takeouts of the budget. I noticed one commentator, they were appreciative of the budgets this year in October, so it finished while it was still light and didn't drag into the night. So Andrew, what's your takeouts of the budget?
For me, Michael, the main emphasis of the budget was increasing cash flow for spending this year. Obviously, we're seeing sweeping changes brought forward with tax brackets to enable, I suppose, tax relief now, which is the focus. And I suppose that the net result of that is hopefully gets more people spending. That flows through into spending into businesses and so into hopefully, I suppose, net result get the economy moving again to employ more people.
That's the government's sort of game plan, I think. I mean, they can take a horse to water, but can't force it to drink. So, what percentage of those savings are saved, and what percentage is spent will play out the next few months. But that's pretty much
the emphasis.
Individuals, and backdating it as well. We've seen that before. So
no, and that was one interesting piece that I found that, especially for small business, that you can backdate some losses, which is interesting. Normally, obviously, you carry forward those losses, so that's a big change. I suppose from my perspective in financial planning, there hasn't been too much change, and we're used to a lot of change that happens in financial planning every budget. So we've kind of left many things alone. There's not much talk around the change to the SG, which I thought was interesting.
For the superannuation
guarantee.
Yeah.
I think there were some commentators prior to the budget announcement talking around should they retract the progressive nature of the super guarantee.
Because I think it's either legislated or planned to increase from the 9.5 to 12 over a period of time. So
to 12%. I think
it's a bit of talk about deferring that with the current recession we're in.
Yeah, that's right. So I thought that might have been a key piece that they talked about. Really, we went through the keeper as such. So
the tax cuts really, as we said, go back to 1st July 2020. So there'll be a bit of an extra windfall for the employees this year. In that tax saving will come forward in, assuming from the end of October or something like that. So the remainder of the financial year, 8 months, you'll get that saving. That will just come through your wages. You'll just have an increase in your net wages being paid by your employer during that year, during that pay period. And pretty much it's the tax bracket that's up to what used to be up to 37,000 for 19%. That's pushed through to 40 odd grand, 45.
Yeah.
And just, I suppose, an important element just to recap on the nature of our individual tax brackets. So it affects people in that bracket, but also affects obviously people in the upper brackets because they get that same benefit as well. So there's two brackets that they've adjusted the thresholds of when that applies. So 37 to 45 to 19%, and 32.5%. The next bracket up, it's gone from 90 to 120.
120. Yeah.
So anyone sort of 120k gross and below is effectively 2 wins in a lower tax bracket. So they'll flow through people's pays and that's what they want to do from there.
Yeah, and as far as I'm aware, I tried to push that through yesterday.
I just got an update about an hour ago that it's passed the upper house.
Yeah.
So I don't think we've got any opposition from the other side of Parliament through this one. I think it's just a spend.
Yeah.
The other one is sort of a minor amount. I just noticed that the middle income tax offset, so it's sort of the rebate that was introduced a couple of years ago. They've extended that for another year as well. That's 1,080. It was a stimulus measure a couple of years ago that's still still hanging around to try to stimulate more into the economy?
Correct. Yeah. I suppose one of the criticisms I think which was always going to be the case is that I suppose the opposition felt that there wasn't enough relief for lower income people. And there's more of a focus on, I suppose, getting people back into work in their 20s and 30s, which missed a lot of people who might have been put out of work because of COVID.
So that's been a definite strategy to target young people and I suppose stop that intergenerational unemployment that can affect young people who can't find regular income. So it's on a different path than what society would hope.
So lots of emphasis on, I mean, in my view, overarchingly not a huge amount of changes to superannuation. Interestingly, Michael, they've introduced the, I suppose, the comparison tool that's going to come out and compare my super products in the market, which will be interesting just to make sure that they're doing the job that they've got the mandate for. And that would be interesting. But to clarify, that's more around all the My Super options.
Just to remind me what the My Super is again?
Is the government mandated. So I suppose setting to get funds that you as an employee might just join a super fund and to make sure that you're invested in a fund that's reasonable to your age and risk profile.
That's the one you tick the box on the form to say here's where you want your employer contributions to go to.
Yeah, that's right. And there's been, I suppose, a little bit of criticism that they've underperformed the market because they're a little bit more, I suppose, defensive in their approach. So just to compare, that'll be interesting to see how that rolls out over the next few months. And also the other interesting part for employees was the, I suppose, you take your super account with you, or it's stapled, it's the new term is. So when you leave employment and you go to a job elsewhere, your super account follows you. To me, that was a reason.
Yeah, that makes sense. I think, I can't remember what the stats are, but the number of people that had multiple accounts that just been lost in between jobs is quite high. So.
And that's clearly trying to reduce the amount of multiple accounts that people have in the market.
So I'll move just quickly onto the small business, because that was probably the big winners out of the budget, and the big ticket item is the instant asset write-off.
Which has a different name, I believe they call it.
I think they call it something different now. Uncapped instant asset write-off is on my handout, but they call it something different. So essentially, what that means is from budget night, that if a business, so this is any eligible business, so any small business, and they've extended the definition of small business once again, but I'll just focus my comments on a small business as in $10 million turnover or less. It's the definition I'm more familiar with. And so any asset, so typically buying a new truck, whatever, then you can claim 100% of that on your tax return as a deduction in that year. So normally you would have amortised or depreciated that over a number of years under either small business write-off rules under the Tax Act or self-assessment method. What that means now, so if you buy, say, a $100,000 truck, then you get a $100,000 tax deduction in FY21. So it's a huge win for a lot of small businesses in terms of its tax position. Also related to that is if you have got any depreciated values still on your books, then my reading of it at the moment is that essentially you've got to write that balance off as well. So you've got a double whammy. Still waiting to see some of the details on that, but that's my understanding of the intent, or almost unintentional, that you've got to say, if you've bought a vehicle 3 years ago and it's worth 10 grand on your books, you've got to write that off as well in the FY21 year. So what does that, and you alluded to that before, Andrew, that does may create a tax loss position for the company this year. So, you know, they bought $150,000 worth of gear, the tax deduction for that, their taxable income from trading activities only 100 grand, so they end up with a tax loss for 50 grand for the year. What they're allowing you to do is to go back into previous year, just the 1 year, FY19 as I understand it, or FY20 and FY19, and effectively claw back that loss in prior years, which has never been, I've never heard of before, or you carry it forward as you mentioned. So you might get an additional tax credit, the tax you paid in prior years, as long as you've got what they call a franking account balance greater than zero, or it doesn't put you in a deficit position. So therefore you can get some tax back that you paid in prior years as well. So it's going to be a huge win. So that last comment only applies to companies. It's running to a company tax. But my initial comments about a small business getting immediate tax deduction doesn't matter what entity or type of entity you operate through. So you could be a sole trader, partnership, trust, company, etc. Still get the tax deduction. But to go back and claim previous year's tax, you must be a company, and you can't retrospectively make yourself a company now and go backwards because it's based on prior lodged tax years. So huge sort of benefit. The trade-off, I suppose, is businesses have confidence to invest, but from a tax perspective, you know, it's a massive win for businesses in that space.
Yeah, especially if you're looking like you're going to post a profit. Then obviously you've got the ability to post a loss now.
Yeah. Another little caveat is that you know, you're making $150,000 profit, you go and buy a new Porsche, then you don't get the full 150. The depreciation cost limits, which is about 56, 57,000, something like that, still apply for motor vehicles. So you only get the maximum amount of write-off for a motor car. But if it's a truck or other piece of plant, then there's no limits as before. So you can't quite all your tax off against your luxury cars.
No.
So don't worry about that one. So that's that. The other one I just wanted to make mention as well was just I think it's a great move, the apprentice and trainee wage subsidy. They introduced that for a period of time during COVID. Then that sort of got swamped a little bit with Job Keeper, sort of phased that out a bit. But I think from the 5th of October, something like that, if a business employs a new apprentice or trainee, then the government will pay 50% of their wage, up to 50%, and up to $7,000 per quarter. So I think it's going to be their target market for young people. I think it's going to really appeal for that type of things, and for people, businesses to have a bit more confidence to put someone on. I was only talking to a small business guy last night, and he's sort of umming and ahhing, he's trialing a young guy. I said, look, government's going to pay you half the wage. You know, have a crack and put the young guy on. So, you know, it's just the tipping edge to do that. And because we've got up to $7,000 a quarter, then hopefully my system mature age apprentice has been put on, something out of, say, the hospitality industry needs to be retrained as a mechanic or something like that.
The other thing I was thinking about, Michael, was I was listening in on a discussion yesterday. Didn't quite get the full picture of it, but I thought you might like to explain it a little bit further. Is the incentive to employ people who are on job seeker for up to a month?
Yeah.
One piece I did feel that the government probably missed the mark on is people leaving. The university's probably been a bit of a disaster this year for many, but people who leave employment, leave the university system as you're looking for new roles, there didn't seem to be much incentive there for people who suppose were not under a job seeker arrangement. Yeah,
no, this is targeted, so there's winners and losers in this arrangement, and it's pretty much aimed at young people. So I can't remember the figure off the top of my head, but it's $200 a week up to the age of 30 or something like that. Someone who is on unemployment benefits essentially for a month or something like that. So it's really trying to grab people out of the unemployment queue and giving employers a bit of incentive to put someone
bring them on.
I think it's for a minimum 20 hours a week you've got to put someone on as well.
Yeah.
And I think that's the one you've also got to increase your total number of employees by that extra person. It can't be a replacement. The thing is, for me, there's probably too many hurdles for this to be a wide take-up. Whereas the apprentice one, I can really see that's not applied apprenticeships and also just trainees as well. You put an office trainee on for us or whatever it might be. Half a wage is a substantial. $100 a week for someone in their early 30s. Yeah, it's sort of an incentive. Does it force people to make people beat the door down to put someone on? No, not really. I'm sort of thinking, and it doesn't also address retraining, I suppose, out of some of the older employers that will, in any sort of economic dislocation and retraining, then there's really no incentives for employers to put an older person on in that space out of this budget. There was some minor tweaks. They allowed FBT exemptions on retraining costs that didn't relate to your profession.
Yeah.
So, but it's probably 1% type of sort of throw it out rather than being a fundamental approach there. So they're the two big takeouts for small businesses: is incentives to put apprentices and trainees on, and secondly, your tax benefit of buying equipment and assets.
Yeah.
So there'll be two winners there.
And hopefully with people spending, it sort of flows into small business as well. And,
that's the intent to create more money flowing through the economy.
Yeah.
There's been some commentary about whether there'll be a third round of accessing your super. That didn't come out of the budget. I don't think it's going to happen. I think let's wait and see what the stats show. I noticed there's got another $300 million to the Bureau of Stats to keep invest more in giving some more timely information of how some of these measures are going to flow out into the economy. So I think they're going to watch things pretty closely to see what effect it does have in terms of generating economic activity and not just paying down debt. So we'll wait and see.
Very good.
So that's a bit of a wrap for us, I think. So, a bit more money flowing through the system. We're going to be go as a government and country more in debt. Debt's cheap. That's sort of the game plan, and trying to generate more jobs in the economy. So
just getting more cash moving around and people spending and businesses, I suppose, that effectively are a little bit of survival mode at the moment. Can ride out the time.
All right, we'll wrap that up. It's just a short, sharp top 2 or 3 items that we found out of the budget. So we've got some notes. Andrew's always got very comprehensive notes, and we're happy to email those out to you and put them on our normal platforms. But if you wanted to be on our mailing list, we've got a newsletter that goes out, a distribution list. So drop us an email through the MBH or Financial Streams websites, and we'll add you to our database and send you the information that comes to hand. So thanks for tuning in.
Thank you.